Another volatile week for stocks, capped off with the latest jobs report on Friday, as well as the president's economic team visit to China to discuss the trade imbalance and the theft of intellectual property by China. Joining me right now to talk about all of the above from Dallas, one of the most respected investors in the world, Kyle Bass is the founder and chief investment officer of Hayman Capital Management. Kyle oversees all of the firm's investment activity. And it is good to see you this weekend, Kyle. Thanks so much for joining us.
You too, Maria. Thanks.
Let me get the macro story from you and your reaction to the jobs numbers out on Friday. In terms of the jobs created, the number of jobs, it was a little weaker than expected, we know, even though the unemployment rate falls below 4%. What was your take?
Well, you know, my view on jobs is here, you have to think about the macro of what our government's doing. You know, with the tax cuts, we're going to stimulate our economy by about $350 billion over the next 12 months. It's very back-end loaded towards, call it, the beginning of 2019. But we are stimulating while we're at full employment. And so we at our firm believe that is going to lead towards inflation, and it's going to lead towards wage inflation. But again, this also goes to the larger argument that if you look around the world and you look at how much money the global central banks have printed, we look at the world as kind of global M2, which is basically money around the world divided by global GDP. That ratio is the highest it's ever been in world history. It's 110% of global GDP is where M2 sits. And historically, throughout the last, call it 100 years, that ratio is somewhere between 30 and 50%. And today it's at 110%.
Wow.
So we see so much money around the world as a kind of unintended consequence, believe it or not, of QE. So we see the wealth gaps widening. We see full employment in the skilled labor sector. And we see maybe permanent unemployment from the displacement of factory workers by China and Southeast Asia. So it's this fascinating world that we're living in today that, let's say, textbooks don't have an answer for.
You know, you would think that with the growth that we're seeing in the U.S., you would think that the dollar would be trading better, but that's not the case. So what do you want to do based on all of these signals? You want to short this market, or you want to be all in?
I want to be right in between there. No, I think that so what I'm trying to say is you're going to see real inflation happening. This time it's going to be a global phenomenon. It's not going to be, let's say, contained by a sovereign wall or one country's fiscal policy. It's going to be global in its nature. And that's something we really haven't experienced as a world in a very long time. And so when you ask, do I want to be all in the stocks or I want to be short, you know, I think that there's so much money around the world that, you know, I'll give you an example of kind of some of the ridiculousness that we're seeing is, you know, we just had a painting auction that was maybe Leonardo da Vinci, we're not sure,
right,
that was restored, and it's an entire background. It traded for $450 million. It was a picture of Jesus, and it was bought by an Arab. I mean, you can't even make this stuff up,
right.
What's
That's
going
funny.
on out there these days.
Well,
and so I think that I think you're going to see, in periods of inflation, and maybe we'll see stagflation, right? Maybe we'll see nominal growth move higher and real growth stay flat. And in those periods, stocks, you know, in inflationary periods, stocks keep up with about 75% of the number. So I'm not saying be short stocks. I'm just saying that this macro environment that we're kind of heading into, given all the central bank's actions, the Fed pulling back, the BOJ staying on the gas pedal, China staying on the gas pedal, and the ECB might be pulling back, I think you just need to be very, I know this sounds like a weatherman, you need to be very selective about what you buy, but you don't want to be short the whole market. That's my view.
So where do you see growth right now? Where are the opportunities from your standpoint? Yeah.
You know, we look around the globe, and so we own some things here in the U.S., but the majority of our capital is focused on where we see opportunity in Southern Europe, and primarily Greece. Greece has gone through a Great Depression, a 30% real GDP decline over the last 8 years. You think about the U.S. Great Depression, we had a reflexive snap back in 2 or 3 years. They've had 8 years of a complete disaster in their economy, and you're seeing every macroeconomic indicator in Southern Europe is heading higher right now. And so we think that there is tremendous opportunity in a very small country in Southern Europe. And that segues into even Latin America. You've probably seen in the last week or so, Argentina has had to absolutely moved their short end rates in emergency fashion multiple times. They've moved it almost 900 basis points in about a week. Imagine if the U.S. raised the front end 9% in a week. So their Argentinian T-bills are trading at 40% yields today, and their currency's gone from 18 to 22 to the dollar.